When you look back over some of the horror stories involving deceptive accounting techniques, John, it seems as if a lot of them involve the issue of revenue recognition. Why is that?
It's easy. That's probably the simple answer to why. You can make a simple journal entry to debit accounts receivable and credit sales, and you've overstated revenue, and you've overstated net income. It's simply an easy thing to do. When we take a look at the topic of improper revenue recognition, we know that more than half of all the accounting frauds that take place deal with revenue recognition. The approaches companies can take, particularly in terms of developing supporting documentation, are generally speaking just easier in this area. Whether you want to overstate, which is what we normally see, but you could also understate also. And the overstatement that tends to take place, which is the issue, tends to be more focused on wanting to achieve a predetermined goal. And that's the problem that we have with the current economy, is that these folks have predicted that revenues and earnings would be X. The economy isn't allowing that to take place, but they've made public statements about what the results will be. They've, as I said earlier, have stock options they want to maintain prices on. And their expenses, if you want to manipulate expenses, are simply more difficult to do from an accounting viewpoint. It's easy to do it from a revenue recognition viewpoint. If you take a look at just some of the past frauds, Enron overstated revenue by a substantial amount, just a huge amount. Tyco overstated revenue by a huge amount. If you take a look at WorldCom, they overstated revenue by billions of dollars we're talking about here. And in many cases, this was a pattern of behavior that took place over a number of years, and it wasn't picked up by anyone over those numbers of years. One of the deficiencies that we saw with the past frauds from an audit perspective is doing analytics, ratios, comparables, etc., that were annual to annual, meaning did last year to this year, you did 2 years ago to this year. Well, if each one of those years had fraudulent activity in it, then you match them up as comparables, they look like they're very comparable. And some of that got missed because of some of those approaches. With the new standards, the requirements include having to look at information in a more disaggregated approach, more of a drilled down analytic, more of a monthly as opposed to annual. And that's been very helpful in identifying relationships and circumstances. But back to the issue of revenue, though, just for a second. You could do revenue any one of a number of different ways because we have about 160 different acceptable revenue recognition methods in this country. Many are industry specific, but when you have that variety of what's acceptable, it lends itself to abuse, it gets in the way of effective comparability, and it permits folks to play a little bit simply because there are so many more acceptable approaches that are in the literature. I mean, you can look at, there's accounting for vendor rebates, there's accounting for multiple deliverables, there's accounting for lessor accounting, there's point of sale, there's construction accounting. There's so many different kinds of approaches for revenue recognition that, combined with its ease of manipulating something, gives oftentimes the impression that things are reasonable, things are appropriate, when in reality they're not.